Welcome back to Do More with Your Money. On today's episode, I am joined by John Briggs. John is the CEO of Incite Tax, a Utah-based CPA firm with over 30 team members serving clients nationwide. He's also the author of the books The 3.3 Rule and Profit First for Micro Gyms. With over 15 years of experience as an entrepreneur building a multi-million-dollar CPA firm, John knows what it takes to navigate the inevitable challenges on the path to building a highly profitable business. John, thank you for coming on the podcast today.
Yeah, thanks for having me, TJ.
Awesome. Well, I'm really excited to talk to you. Obviously, you have a long history of successful entrepreneurship. So, looking forward to learning more about that. I'd love to just hear a little bit about your story of how you got to where you are today. In particular, interested in hearing how you built Incite Tax into what it is today and if you approached it with a profit first mentality.
Yeah, so it's a bit of a path. Most universities and the university I went to kind of teaches you how to be someone else's employee. Nothing wrong with that. My first job out of college was working for a company that did door to door sales, and I was their controller. And I learned when that company did $30 million in revenue, it also declared bankruptcy the same year. And so this idea that I'd been taught in college about, the best job security is to work for a large company. I think most would agree $30 million in revenue is pretty good, but they still went under. And so now I found myself unemployed. And it was at that moment I realized, well, maybe having control for myself made the most sense. And for my personality, it ended up working out. And so I went down this path of, well, I have a master's degree in tax. What does that look like? Let's get some experience working at another firm. I spent some time at a big four company called Deloitte, spent some time at two smaller firms, and saw a lot of things, mainly that I didn't like. Unfortunately, that's how my brain is wired. Drives my kids and wife insane that I often just see the problems instead of pausing for the good things. And so I wanted to create a firm that didn't do all the things I saw that I didn't like. Because I wanted to basically create a firm that if I were working in it, I would be happy working here. And so it started first with this scenario where the firm I was coming from, really poorly run. I'm sure some of your listeners have bosses and supervisors that may fit this, but it's like I did all the work, period. It's like if they brought in new clients, I still did the work on it. If I brought in the new client, I did all the work on it. For all the past clients, it's like I did all the work on it. And then they're spending time doing something not related to the firm, but also using the business as their personal bank account. And I went 6 months working for them, receiving a total of $2,500. It is very hard to grow wealth if the shovel you're playing with can't fill up the hole fast enough. And so it was at that moment I kind of was desperate enough that said, look, it literally couldn't get any worse in fact, this is the worst case scenario because if I were unemployed and doing my own thing, I could sleep in all day. Here, I'm working for someone else and not getting paid. Like, that's terrible. So, started off windowless office, just myself, doing all the things, wearing all the hats, admin work, sales, marketing, actual CPA work. And it was a lot. Learned a lot during that period. And I don't recommend anyone ever go through having being forced to work 80 to 100 hours a week. It's hard. It's hard to live a life there. And we had some young children at home and definitely received some painful comments from my wife when she'd say, like, during tax season, I'm basically a single mother. And it's like, ouch, that hurts. So I wanted to be better and I wanted to create a firm that allowed work life harmony. And so we went from this state of just me doing everything to that scary first step of hiring the first employee. And it we were able to grow the firm on a couple principles. One of them first is the idea that, like, at the end of the day, my clients paid all the bills. And so I needed to keep them happy. In our industry, accountants often can make the client feel like the accountant's working for the government and not for the client. So we want to make sure we are client focused first. I also have an inability to say no. Hey, can you do this? Sure. Just keep piling it on. Um, worked out well as you grow a team because then the team can help take over some of that stuff. But yeah, so we went from the one man shop, windowless office. We have 230 team members now.
Oh, wow. So
We've
way more than
moved
30. Sorry.
way more than 30. Yeah. Uh, we've moved around to variety of locations with that growth. Got to find more space for people. We definitely have a ton of more than half our team at this point is remote, but yeah, it's been a fun journey.
That's amazing. I mean, I'm impressed by that. I mean, I consider myself, I guess, self-employed solopreneur. I have a financial planning practice, and it's still just me. I do use some like part-time help, but I'm just interested to hear like how do you go about taking that leap and really starting to delegate, and also, yeah, I guess just really still trying to keep that profit first mentality with kind of letting go some of the reins there.
I think one of the most important things that I have found is really understanding actual profit on the service you're doing. So if I get in a new client, how much revenue is that? What are my actual costs? And when I say actual costs, I'm not talking only hard costs. I want to look at all the costs. So if I have a team member and it's going to take that team member 2 hours of work, what does that cost me to pay them? What does it cost me? Like how much training went into that? Are there marketing things that went into that? Is there software I'm using that I'm paying for? And so once I understand the actual profit on each service, then I can forecast better, oh, based on that, I know that when I add my 10th client from this moment on, I really am going to need someone else's help. Because in that process, you also look at what's my capacity. Like I can handle the 10 more, I guess. But if I do, now I'm working too many hours. I'm a big proponent. I think the culture that we live in now is definitely more on this pendulum side of hustle culture. And I think we need to dial it back and bring it back to the world's a better place if we have more work life harmony. So I think that's important to take into consideration as you're kind of forecasting out how those things go. But that's how we did it. So, like right now, I know that every 350 new clients we get, I need to hire another accountant, and every 700 new clients we get, I need to hire another admin. We've done the math, and I know what the costs are, and that's kind of the pace at which we need to do that.
Okay, no, that makes sense. I mean, that's very impressive, like the size of the firm that you've built. I guess, so in my experience, a lot of people don't necessarily know what to expect from a client CPA relationship. And, in your opinion, like what is the accounting industry getting wrong and how do you think clients should be served? What does that relationship look like and how is Insight Tax different?
Yeah, I mean, first thing I see they get wrong is client will come to the CPA and say, "I have this idea, or I read this, or I want to do this," and the CPA says, "No, you can't do it." That's wrong. Like the tax code, for those who aren't aware, it's a riveting read if you want to put yourself to sleep at night. It's like 75, 78,000 pages. And every time there's an election and new bills get passed, it gets bigger. They don't simplify anything, they just add to it. And with that means there is so much gray area. I say gray area in the sense it's easier for people to understand that. Well, the technicality is there's a rule and then there could be exceptions upon exceptions upon exceptions. Those exceptions are what most people would think of as gray areas. They're not really gray, but it's a technicality. I think a CPA, you should expect a CPA to say, like, well, let's talk about it. What exactly are you trying to accomplish? Is there a possibility we can figure out how to make it work? We do that. And sure enough, sometimes it's like, yeah, sorry, we really like, you don't get a tax benefit from that, or that's not going to make sense. But a lot of times we can find, like, well, if you structure it this way, or if you did it in this order, then maybe you can find more tax savings. I think also you get some accountants. The perception is, oh, you're a CPA, you know everything. Um, Not true. The CPA exam covers so many different things. About 10% of it relates to tax. As an example, I remember talking to a lady about 10 years ago, and I reviewed her tax return and I said, "Hey, you know what? She was filing some income on a Schedule C." And I'm like, we could take that Schedule C income, you could create a business entity, and you're going to save $10,000 a year based on the returns you sent me. You've overpaid in tax about 100 grand over the last decade. And she was happy with that information, but at the end of the day, wasn't willing to switch because the accountant that she's working with goes to the same church that she goes to, and she didn't want to hurt that relationship. And I said, okay, well, just so you know, as long as you understand and accept you're purposely choosing to pay $10,000 for a relationship, then great, good on you. But I asked her, I go, why not ask this? CPA though why he hasn't suggested this. And she did get back to me, and basically he just wasn't comfortable filing business returns. He didn't know how to do it. And therefore this client suffered. So I think it's important to interview and ask, and if they seem to hesitate on certain questions, it's okay to not hire them. You should be interviewing them as much as they're interviewing you as far as working out that relationship. Now, that's on the slide where I blame the CPA. There is another side of it that I think is worth mentioning. We don't have crystal balls. The only information we get from a client, like about a client's tax situation, comes from the client. Very rarely do we get a letter from the IRS first surprising us with something. And there is a bit of a perception like, oh, you're a CPA, you're doing my taxes. I expect you to be able to call me up and tell me, hey, don't forget to do XYZ, or you should now implement this new thing. Well, I don't know what's going on in your life. And so, like, the only way for me to actually be proactive with clients is if they respond to our communications. We do a good job as a firm trying to put as much information out as possible, which a lot of firms don't do. But if we're putting out that information and the client reads it, the goal is we're trying to trigger things for the client. Like, oh, I didn't know that. Let me go talk to my accountant about that. Instead, if they're not reading the stuff, it's really just, hey, this happened to me and you didn't tell me about it, and I think I overpaid in taxes. Like, I literally didn't know it happened. I'm so sorry, but you would have to tell me that it happened in order for me to know that it happened.
For sure. Yeah. No, I think it's always good that the client takes some accountability, even in a financial planning, wealth management relationship. If you're like not disclosing certain things, then that doesn't help. You wouldn't go to your doctor and say, and not disclose certain health issues, right? Or go to your doctor and say, prescribe me this, right? You should work in a partnership. So you bring up some really good points. And I also feel the same way about the wealth management industry as far as like, hey, do you really understand like what you're getting from your professional? Like, are they, are you doing business with them just because you like them and you go to church with them, or are they actually, is there a value proposition behind that? So I can definitely resonate with that.
And in defense for you, TJ, and other wealth planners, I had a friend of mine who's a wealth planner. I loved his response. Don't necessarily recommend giving it in this way, but he had a client that was really mad at him because the stock market dipped and therefore his portfolio value dipped. And my friend responded with, Bob, I am so flattered that you think I control the stock market at that level. You filled out this information for us, which tells me you're a very conservative investor because you asked for us to do conservative investments. And let me walk you through the investments, see how all these are conservative. And these are ones that were hit really hard with the different market shift that just happened. So he explains them like, I'm still investing based on the information you gave me. I'm happy to update how you want me to invest your money, but you know, you guys don't control the stock market. You're just doing your best to help the client based on what they've asked you to do.
Absolutely. Like that's why I preach to the clients, like we focus on what's in our control, right? So like returns to the stock market are not in our control, but maybe one thing that is in our control is this idea of tax planning. And so that's why I'm excited to talk to you about it. I guess one thing that I try to approach with clients from the wealth management end is thinking about this concept of minimizing your taxes over your lifetime. By the way, I really like your shirt, hashtag IRS
Yeah.
sucks. I don't disagree. And I'm really a big proponent of, hey, let's try to minimize your lifetime taxes. And so the kind of the tools that I look at are, how much do you own in like your tax-free bucket in your Roth versus your tax deferred, maybe Roth conversions over your lifetime if it makes sense. How do you think about, clients who want to just like minimize their taxes in the current year versus maybe having that longer term approach to minimizing lifetime taxes?
Yeah, great question. Our focus as a firm is actually helping our clients grow their wealth as opposed to minimizing their taxes. And certainly most of the years, let's try to get that tax down as low as legally possible. But there's definitely scenarios where, they're trying to do some stuff and they have an investment real estate property they want to buy. Well, if we're going to do XYZ over here in your taxes, you might not even qualify to buy that property that we can look at the numbers and say, this is definitely going to help you grow your wealth. So let's forecast all those things. In this case, let's talk to your underwriter first and see like how far can we go. And if we can minimize your taxes and you still qualify, awesome. If not, maybe you don't want to be as aggressive on some of your tax strategies. So that's often the first approach. But it also comes down to what is their preference. We plenty of clients, 401ks, IRAs, those types of things are great. There is a group of people in the world who prefer alternative type of investments, and so that's also fine. I think I just tell people probably the same stuff you do. You don't want to put all your investment money or all your retirement money into one vehicle. So diversify a little bit. And so if you have $50,000 in your 401k, I'm not necessarily recommending taking that full 50,000 and putting into one oil investment deal because there's no guarantee there. And helping people understand the risks, like there's a reason why some of these things are more popular than others because they're a little bit safer, and the ones that aren't as safe, they might get a lot of hype, but I just want to make sure the clients understand the downside for sure.
No, absolutely. That makes a lot of sense. And I'd love to get your take on a couple specific tax planning things that I see clients, or I see on tax returns sometimes that I find questionable. Again, feel free to not answer the question if it's too granular. But like for example, you mentioned real estate. Okay, so this is a big one that I've noticed people are either very big on real estate or very big on the stock market. Typically, they don't like both,
That's
um,
interesting. Yeah.
which is kind of an interesting thing. But what is your take on qualifying as a real estate professional? Because sometimes I'll see people like deduct losses as like a real estate professional when like maybe they like sell software in real estate or something?
Yeah, so the rules are pretty specific when it comes to the hours. So it is kind of a black and white calculation. And in general, if a person has a full time W-2 job that isn't a realtor,
That isn't a realtor. Okay.
right?
Yeah.
All like so selling software, even though real estate people buy the software, that's not unfortunately not real estate related based on the activities that qualify for the hours. Very difficult for a full-time W-2 person to qualify for real estate professional status. So in those cases, we will go and we'll say, well, let's look at your spouse. What is your spouse doing? If your spouse doesn't have a full-time job, then we want that spouse being the one documenting and doing the real estate hours, because as long as one of them has real estate professional status, then they both basically get the benefit. Now, depending on your income, as long as it's not too high, everybody gets up to $25,000 of real estate loss they can claim without having to be a real estate professional status. But
Real estate loss from like including things like depreciation or
yeah,
okay,
yep.
cool.
Yeah. So, like, a little technicality here, but real estate income, according to the tax code, is called passive income. And if you have passive losses, the IRS only lets you take passive losses to the extent you have passive income. My W 2 income is not passive income. And so they wouldn't look at that calculation. So if I had a $100,000 W 2, but a $10,000 real estate loss, technically I can't offset those.
Got you.
But in these passive rules, a normal person under, I don't remember the exact number, but there's a threshold. I want to say it's like 100, say it's around 150 grand. If you're under 150 grand and you have that $10,000 real estate loss, including your depreciation, you'll actually get that as a tax benefit on your tax return. It's like up to 25 and it phases out. But yeah, we definitely don't want to play the game where we're trying to force a real estate professional status. There are specific activities that qualify. I don't have the link exactly, but I know I did a YouTube video on this on our YouTube channel talking about real estate professional status.
Cool. I'll have to link to that in the show
Yeah,
notes.
it comes up all the time. And I lay out there's like 7 to 9 activities that qualify. And yeah, if you're doing those hours, document it, count the hours. Awesome, great. But sometimes it's not worth it to be that aggressive.
What's a look back period look like if you are doing that and it's you maybe shouldn't have been? Like, how far back can the IRS audit you? I guess.
So standard rule is they have 2.5 years, up to 2.5 years to audit you. They have the burden is on them, but if they can prove you committed some sort of fraud, they can go back 6 years, or depending on the extent of the fraud they think you have, they can go back forever. I've never seen them ever go back forever. I've seen them try to push someone past their like call it a 3-year window. The burden's pretty heavy though, and in every case that we've defended a client on that, they've lost. So they really it's only the last 3 years. So if we're the recording of this, 23 is the tax year that's being filed. So they could go 23, 22, and your 21 return is kind of technically still up for grabs.
Well, that's good to know, and I appreciate you sharing that. Another one, a common, I guess, pitfall that I see or debated is for maybe the small business owners out there is LLC versus S corp. Okay, and when to elect S corp taxation. In your opinion, like what are some things that business owners should consider when electing S corp?
Yeah. So the big thing that we're trying to minimize here is self employment tax. If I'm just an LLC, the IRS, and I own that 100%, the IRS is going to say, file that on your personal return on a Schedule C. That means, let's say there's 100 grand of net income. I'm going to pay income tax on that. And I'm going to pay 15.3% self employment tax on top of the income tax. That's Schedule C. That's not a great tax scenario. If I have me and at least one other member of the LLC, that's a separate tax filing, but I still have the self employment tax problem, which is why in some cases we like the S corp because you don't pay the self employment tax on the 100 grand. There's some complicated things there, but you don't pay it. You don't pay it on 100%. You pay it on a lot less of a percentage of your revenue. So just so people understand, that's why this is a question that comes up. Like, when should I elect? Because when should I save money on that? I think anywhere between 10,000 and 15,000 of net income, meaning after I have my business revenue, I subtract my business expenses. If I have 10 to 15 grand left over, I probably want to consider an S corp, especially if it's something I'm going to continue to do going down the road because I'm going to save anywhere from even on that little bit of a net income, I'm going to save anywhere from $2,000 to $3,000 in taxes, and most CPAs aren't going to charge you $2,000 to $3,000 to file your S corp tax return. Certainly, if you're above 20 grand, to me it's a no brainer. So I look at the net income number to help me determine, is this a conversation we need to have with the client?
Okay, that's interesting because I also from the financial planning world, it's debated a lot, I guess, if things like QBI, right, as far as like how that also factors into this calculation, and if it because you can lose that deduction there, and then how much are you really saving on the self-employment taxes and those kind of things.
Yeah, so QBI, qualified business income, it's basically this kind of potential 20% haircut that the government gives us after the 2018 tax laws were passed. Meaning, in simple math, if I have $100,000 net income, QBI potentially means I only have to pay tax on 80 grand of it as opposed to 100 grand. But there's limitations, which is why you brought this up. So if I have an S corp, I am required to pay myself a W 2. And in the cases I've seen, that W 2 is enough to get the benefit of the QBI. And so we haven't run into that issue where they're losing anything with the QBI by electing to go S corp. And in most cases, because of the self employment tax savings plus the QBI, they're definitely way more favorable to be the S corporation than staying as the LLC. It's never 100% because of all the many situations, right? And so a good CPA should be able to do a tax estimate for you. I mean, we're at that time of year where year-end planning is a big deal. And so we'd be sitting down with clients who have maybe been in LLC all year, and we're going to say, well, let's look at, do we need to elect to be S corp before the end of the year? And we're going to look at those numbers. We're going to do the math ourselves and figure out, okay, yeah, you're going to be favorable over here or not this year. So
So
keep it
run the
as the
numbers.
LLC. Run the numbers.
Love it. I love it. And you did mention that, the potential change, right, with tax law. This is always something that is unknown in the future, right? And a lot of people are speculating that, well, I think it's going to happen that the Tax Cuts and Jobs Act is going to sunset back to the, former rates. How do you work with clients in approaching this maybe? And are there any things that people can do to think proactively and consider before that happens?
My best advice on that would be don't lose sleep over it. I mean, even right now, we're in a big election cycle, right? And you have all parties talking about their tax plan. Even those who are talking about things that, in my mind, make zero sense, we have to realize that just because a president has an idea of what they want to do, Congress still has to pass it. The Senate and the House still have to pass it. I am not aware of a president signing an executive order that forces a tax on people. And so because there's so much talk and so many possibilities, and I can have a plan. Like, that's the way government works. A guy has a politician has a plan. They have to present it to the floor or whichever group they're in, and then they got to talk about it. And usually that involves lots of changes. It's why most of these bills are never one thing, is because everyone's making concessions to get it's a broken system in that regard. But all I'm trying to say is there's so many things that happen between the ideas that we may hear on the media right now versus what would actually happen when the law changes. And so we do our best. I kind of ignore all the talk until it gets to the point where it's either passed in the Senate or the House. And then I'm going to start looking at it a little bit. But for sure, then once it becomes a new law, then we got to look at the repercussions. And in that case, we're usually on our end doing research, and then we're going to push out to our clients, hey, here's a new tax law that we think is going to affect you. So there's a lot of tax laws that honestly are pretty black. They're black and white enough that there's nothing you can do about it. It's just, it is what it is. So there's no planning that can happen. It's like, oh, I had this scenario. I guess I'm going to be taxed on that. That sucks. Like, yeah, sorry. So we try to focus on the ones that we have some control over getting around or planning through. But so if someone changes something on the standard deduction, like the standard deduction is what it is. It decreases your tax, or they're going to reduce it, and now you're going to pay more tax.
Right. Yeah, in your opinion and in your experience, do most people know how much they're paying in income taxes, like or taxes in general, but I guess particularly income taxes?
I think most people only know on April 15th or whenever they file their tax return. We do our best to help our clients not be super surprised, but yeah, it's pretty common to hear the response like, "Oh, I didn't know I was going to owe that much money in taxes," or "Oh, I thought I was going to owe more." People just don't tend to know. They don't think about it. I don't.
That's fair. Yeah. I just feel like it's, it is probably one of, if not the largest expense you'll have in your lifetime. If you're a high earner, I suppose. And I just feel like a lot of people don't always understand, especially if they're living in an area where there's like a city tax on top of the state tax. And it's like, all these things. But I guess, so yeah. So basically back to, minimizing taxes over one's lifetime. Is there any, in your experience, like what are some common ways that people end up overpaying in taxes?
The most common way to overpay is to leave deductions on the table. Um, and some of those deductions could be in the form of like, man, if you just contributed a little bit to a retirement account, whether that's an IRA or a 401k, you are probably getting the tax benefit back from the back end versus the cash that's going into it. A lot of people also, they do want to DIY it, right? I mean, we charge for our services, and some people don't want to pay that. I'm not going to call them cheap. We all know those people, but I get it. Sometimes it's like, look, I can use TurboTax, and it's fine. Well, on one hand, maybe the software is fine, but all the software can do is ask you, how much did you spend on this, or what is this? And it doesn't do a great job explaining, like, well, here are all the things that that could be. So did you have any of those? It never hurts to sit down with an accountant and find out, is there something you're missing in your tax situation? But I think if someone's DIYing it, it's almost a guarantee they're missing something.
Yeah, speaking of the DIY and TurboTax, and I see all the commercials now. They're like coming at the accountants on like this pricing, war. And what is your thoughts on, I guess, the future of accounting, tax prep, and with like AI coming down and becoming more of like a thing? How do you see that relationship evolving, and how are you going to compete in the marketplace?
I'll just say I do think some of those companies are brilliant marketers. And I wish I had their marketing budget. I always love the little fine print at the bottom that no one just ever reads, but I do every time. Like, I'll even pause it to read it. And basically, I mean, whatever they're marketing, the little fine print tells them none of this is true. We actually can't guarantee anything. Okay, sorry, little digression there. I, the most first interesting thing about AI is right now the primary AI is language models. And so, I mean, I've tried some stuff out. I've typed in tax questions into ChatGPT and things like that. It doesn't do a great job. It'll give me an answer, and I'll respond back with like, actually, the answer is this, and then it'll respond with, oh, you're right, and and then gives me a different answer. I should try that on an answer that they give me is correct and see if I can get them to tell me that their correct answer is actually wrong. So there's that, but definitely technology. I mean, we're doing things on our end. Instead of thinking of it as AI, we're actually looking at automation. I think most people don't realize your wash machine, dryer, dishwasher, those are robots. Those are programmed robots. You're not doing the work, has a thing, there's a couple inputs and it does it, right? We're now to the point where a lot of softwares can are trying to get there. And so we're doing things on our end to implement efficiencies as much as possible. Because there is minutia and there's a lot of data input stuff. If I can free up my team's time to get rid of that stuff because a robot or a computer program can do it, and they can spend more time interacting with the actual client, that's a win for us. I think at a minimum, there's no way the government allows a computer to file a tax return at least a decade. I mean, we're still LLCs were created back in the 70s. That was 50 years ago. They still don't have tax code that's specific on how should an LLC be taxed. They've just forced you to tax it like something else based on a couple things. AI might be new to us and it's going to be exciting. It's going to change a lot of things, but the government's going to be really slow to adopt it. So I think at a minimum, if people want a professional, like that's still going to have to be a human. But we do look at it right now as ways how does it enhance our ability to serve the client better? And one of those things is if it's just stuff that's really what we call it incidental waste. The client's not paying for the value of me to basically save their source documents and put it into a storage document. That's not what they're paying me for. But I need to do that in order to do the tax return. So any of those things that exist, we're trying to find a way to just have a robot automatically do it. Because then a dumb robot just does it the exact same way correctly every single time. And my human team members can focus on customer service and answering client questions.
No, I love that, and I couldn't agree more. I think it's a good thing if we can automate away the jobs that are not, enjoyable to do and can be done by a robot, and that allows us to then focus more on the one-on-one personal relationships. So, I think that a lot of people that are afraid of AI or automation are the ones that, like you said, are not necessarily adding value beyond, like, the table stakes,
Sure. Yeah.
So to take a little bit of a pivot here, I wanna talk to you about your book, and I love kind of the work-life balance idea, so I wanna hear more about yeah, basically talk to me about the 3.3 rule and what that means.
I'll start with the definition of the rule and I'll kind of tell you how I got into it. The 3.3 rule states the most efficient workday consists of working up to 3 hours at a time, followed by a 30% recovery period. Hence, the first three is the up to 3 hours, and the point three is how much of a recovery period you should give yourself. And what I love about it is it doesn't matter if you're a business owner, team member, stay at home spouse, what like this is a principle that applies to everything that we do because it's based on science. Right now, today's day and age, Monday through Friday, 8 hours a day, 40 hours a week, we never stopped to think, how do we get here? Late 1800s, common work hours were 80 to 100 hours a week. So we've improved from that. Early 1900s then comes along, and there's this guy who's like, hey, I want people to buy my motorized carriages. How do I get more people to buy it? You know who doesn't want motorized carriages or automobiles as we call them today? People who are working 80 to 100 hours a week because the one day they have off, they literally just need to recover. So he's like, "Okay, I'm going to give them a second day off." He created the weekend for us. We're talking about Henry Ford, guys, right? Creator of the automobile, Henry Ford, first gives his workers a Saturday on top of the Sunday, which wasn't very popular with all his business competitors. And then he said, I'm also going to have them stop working after 8 hour shifts. And so then that's 40 hours a week. And while it wasn't popular back in the early 1900s, things progressed enough over the next 20 years. Government started implementing rules, overtime laws, those types of things. And here we are, 40-hour work week. Why? Because Henry Ford wanted to sell more cars. No science behind it whatsoever. But in the last 100 years, we've had a ton of science that has happened. One of the foundational studies that I looked at for this rule was done by a guy named Alejandro Yeres out of the University of Illinois. And at the time, they're talking about like everyone was like, I want to win a Nobel Prize to figure out What's the attention span? I'm going to be the guy who figures out what's the human attention span. And Alejandro comes along and he's like, eh, is that the right question? Because to him, he's like, if I'm daydreaming, my focus is on the daydream. So it's not attention span. My attention is always on something. So what is it? He was looking at other physical studies about physical stimulus that show a constant physical stimulus becomes neutralized in our brain. As an example, everyone's wearing clothes probably when they're listening to this. You put on your clothes this morning and your brain has totally forgotten about it. But now that we're talking about it and we're bringing awareness to it, you can maybe feel the weight of your shirt. Maybe if you wiggle a little bit, you can feel the friction. Your brain had neutralized that stimulus prior to this exact moment because it was a constant stimulus. They even showed if you stare at an image long enough, it'll actually disappear from your vision, even though it's still physically there. So he said, I wonder, in this whole idea of attention span, I wonder if this same concept of constant stimulus applies to our mind. And sure enough, he found out that constant stimulus of a thought or like task that you're doing, your brain will eventually neutralize that stimulus, which then makes you a lot less productive. And the solution is simply taking time away from that and letting yourself recover, and then you can come back extra focused. So there's other studies in the book that we talk about, but those are the kind of the foundational ideas where we came up with this idea like, yeah, like work is good. I want to work hard. When I'm working, I want to work. I want to be efficient. But hustle culture is work always. And if you're not working always, you're a piece of crap. Like how dare you have life in this world if you're not working constantly? Like, I want to go out eating burritos and doing something type of thing. It's like, no, we humans need break. We're so much more efficient when we take breaks. And so like this isn't about letting people be lazy. This is about really it's a selfish thing that we did because my company's better for it by giving my people more breaks than what the law requires them to take because I know that they come back extra focused. And this applies doesn't you have to be a small business owner like any human being if they start implementing a 30% recovery period to whatever they're spending time on, they're going to be more effective at it
So the maximum still that you say is a 3 hour in one sitting,
in one
and
sitting. Yeah.
and then 30% of that would be the recovery time.
Exactly. So if I worked an hour and I'm getting to that hour, I'm like, I feel like I'm not as focused or I'm really bored or I don't like this task. I'm going to 30% of that would be 20 minutes. So I'm going to take 20 minutes off. If I'm doing something I really enjoy, even if I really enjoy it and I'm really good at it, studies show that even after 3 hours, your productivity is definitely going to decline pretty rapidly. So great. Like even though you love it and even if you feel like you're in the zone, take that break. And then in that case, it'd be an hour break.
Gotcha. Well, it's interesting you bring this up, and it's taken me a long time to learn this. I've been just starting to do some like light meditation, at least to start the day and declutter the brain. But when I first graduated college, I was working in a traditional office setting, and it really wasn't made out for me, which is partly why I went on this self-employment journey. And I feel like I was doing those 8 hour, days, obviously, and then I get more done now in like 3 hours, like you said, than I would in that 8 hour workday. Partly because I'm more motivated because it's my own, I guess, labor that I'm like getting compensated for. But even with that, there were like early days when I would try to push through and have like that hustle culture mindset. And now that I'm starting to take a step back and take breaks, I'm actually finding I'm, like you said, increasing productivity.
I tell people like if you just heard me and you think I'm off my rocker, I want to hear your story. Tell me why I'm wrong. But the only way you can tell me that I'm wrong is you have to try it out first. And I'm confident that when you try it out, you're going to realize not only are you more productive, your stress levels are going to decrease, you're happier, you have the work life harmony that we talk about.
No, I love that. And I also am a big fan of like using money as a tool, right? From a financial planning standpoint. And so this is kind of the same idea that, more is not always better. And like you said, we're not robots, and we're so bombarded with distractions as it is in modern society. We're the devices, we're getting notifications, we can order food to our house, we have endless entertainment. So if you don't go out of your way to kind of declutter that brain and give yourself that time to refresh. And just to clarify this, because I think people might not understand what it means when you take that 30% break. What does that actually look like? Does that mean you're on YouTube watching a YouTube video? Is that considered a break, or is it doing nothing?
As you're talking, I'm like, yeah, we got to talk about the break thing. Because it is about decluttering your mind. It's about giving it pause. I mean, in fact, I have a whole section in the book about boredom and how it's actually super important for our brain. Like I have 4 kids, and it's not uncommon for one of them to come up and say like, "I'm bored." It's like it is. I'm might sound like a jerk father, but my response is, it is not my job to entertain you. And unfortunately, my kids get mad at me when I say studies have shown. Like, oh, here's data, kids. Studies have shown that it's actually really good for your brain to be bored. So awesome. I'm so glad you're developing your brain. Thanks for letting me know. And then they walk off kind of like, oh, you didn't solve my problem. So that being said, when I'm taking a break, for sure, it needs to be not work related. So as an example, when I first implemented this with our firm here, there was initial temptation. I'm doing tax returns. I do tax returns for 3 hours. I'm going to take a break. I'm going to do email now. It's like, no, you're still stimulating your brain with work related activities. That's not a break. Doom scrolling, anything that increases your heart rate. So, honestly, reading news things, because most media outlets write pieces purposely to stimulate normally negative emotions, because that's stronger to humans. Not healthy. We had a team member going through a very difficult time in her life, and they were moving houses. And I was like, if during your break you're talking to your spouse about the move, like that's not a good break activity. So again, doom scrolling on TikTok, any sort of addictive games, Candy Crush, those types of games that people have heard about, not good because you're still stimulating your brain. Now that being said, comedy is a great watching a comedy routine for a break actually is really good for the as a quality break activity. Some of the best places to do that is on social media type of things like YouTube, So if you're doing it, you just want to be conscious about what exactly you're watching. And so if it is a bunch of like comedian riffs, like little sections, that's totally fine. But the whole just like the random stuff is not good for your brain from a break standpoint. And again, I'm not saying don't do those things. I think as humans, we crave variety. We have actually a dichotomy in our minds. We crave variety, and we also crave comfort and routine. So like we're constantly battling ourselves, but like it's fine. Like you want to scroll on TikTok, awesome. I'm not saying don't do that. What I am saying is during your recovery period, as the prep to your next focus period, don't do those things.
That makes a ton of sense to me, and it's interesting that, yeah, being bored has become a skill. Like, it's a skill that you have to learn, and yeah, I see, like, the kids now where they get handed the iPad, and it's like they're never having that time to learn how to be bored with themselves, so I love that, you tell your kids that.
Yeah, it's like people are afraid of boredom, and I don't think we realize that it's one of the biggest culprits to this anxiety culture that we live in. And unfortunately, doctors are just saying like, well, instead of trying to fix it, we'll just medicate people. And like, I'm not trying to say I think there's definitely people who have genetic makeup that do give them an actual disability, but my belief is probably 90% of the people who feel anxious don't have that genetic problem. They've trained their behavior to be anxious behavior as opposed to allowing themselves to be bored. So again, I'm not saying like there's definitely a place where it's a medical thing, but I think most people who suffer from it probably just need to allow themselves to be
Environmental
bored
change.
more often. Yeah.
Yeah. No, I couldn't agree more. Well, I really love and resonate with your message all around, building wealth, having work-life balance, minimizing taxes. So thank you for sharing all the knowledge you did today. If there's one thing that you can leave the audience with, I love to ask is doing more with your money is the name of the podcast. So one tip, it could be on the spending side of the equation, saving, investing, paying down debt. One tip for doing more with your money.
Well, let me give two. They're really quick. The first one is I'm a big fan of this method called Profit First. And people don't have to read the book if they don't want to. It's a great read. But one of the things I think everyone should do is set aside some of their money every month into a tax bucket. You don't ever want to be caught off guard. And the IRS is the last person you want to be on their bad list. And so it's a lot easier to set aside money once a month or twice a month in very small increments than it is to get to tax time and it's like, oh, you owe 10 grand. I don't have 10 grand. But if you save it up every so often, a very small percentage, you'll find by the time you get to the end of the year, you have more than enough to cover any possible taxes and sometimes a little nice Christmas bonus to yourself because you have money left over and go feel free to do what you want with it. That was my first tip. The second one is I heard this concept a while ago, years ago, and I love it. But like if you are in a scenario where you have a lot of consumer debt, I actually believe it's better to pay down that debt than it is to invest into your retirement account. Because right now, if you think about where you're at, if I have consumer debt, I'm at a negative dollar amount. Like I'm not even at zero. And most of those interest rates on consumer debt are ridiculous. And unfortunately, very unlikely you're getting that type of return in whatever you have your investment in. So you actually make more money, more bang for your buck by paying down that consumer debt first. Then afterwards, using the money that you're using to pay that down, immediately take that because like say you're paying $1,000 a month towards credit card debt and you pay off the credit card debt. Well, don't stop paying the $1,000. Just start putting it into some sort of retirement account. You can afford that $1,000 to not spend it. But that's my recommendation. Pay down the debt, the expensive debt first. I'm not necessarily talking about your home, but the expensive consumer debt, pay that down first before deciding to go into the retirement account. That's my advice.
I love that. So take that away is automate some savings that goes towards a tax bucket so that you're not caught off guard come tax time with the liability. And then the second one is if you have high interest rate debt, especially like credit card debt, you should always focus on paying that down first because the interest rate's probably going to be much higher than you could reasonably earn in an investment. And then once you pay off that debt, you don't spend that money, you take that and start directing it towards the investment
Yeah.
side of things.
And make sure you change your behavior so you don't go into that consumer debt again. Like, maybe you take the $1,000 and you put 250 away into a savings account, you put 750 into a retirement account. That way you build yourself a rainy day fund, or even a splurge fund when you want to. But yeah, whatever you need to be honest with yourself and say, what got me into this scenario to get this high interest rate debt? Let me see if I can fix that as well. Because you worst thing you do is pay off the debt and then you're freaking going back and recharging it up.
Yeah, for sure. It's a vicious cycle, and unfortunately, I mean, the data shows like far too many people are in that cycle. So great recommendation. Well, John, thank you so much. This was really awesome. Where is the best place that people can connect with you?
Probably our website for the tax firm is incitetax.com, INCITETAX.com, or I am on LinkedIn. I'm the most active on LinkedIn, so that's probably the best place also to connect with me.
Cool. Awesome. I will link to that in the show notes. And thank you again for coming on.
Yeah, thanks, TJ.